there's something that everybody wants to know. How do you buy your first rental property? What do you look for? How much money do you need exactly? What do you do exactly? How do you know if it's a good investment or not? How do you smash the like button? Which, if you haven't already, please do smash that like button. This video is really meant to be a step-by-step guide to buying your very first rental property. From there, you can continue doing your own research to find out which properties might be a good fit for you. My name is Sherry Hensley with the Living in Galveston, Texas team, and thanks so much for visiting our YouTube channel. This is the #1 place for everything you want to know about real estate. So if this is the kind of information you're looking for, please smash that subscribe button, click that little bell. You'll get notified every time we put up a new video. My team and I, we get calls every day from people just like you who are researching areas to buy an investment property, a short-term rental, a vacation home, or maybe you're relocating. Reach out to us, give us a call, shoot us a text, send us an email. However you want to get a hold of us, we've got you covered when buying or selling real estate. Y'all, let's get right to it. Okay, so we're going to start at the very beginning. Before you even think about investing in real estate, you're going to need to do a few things first to prepare. This is really number 0. Y'all, this may seem obvious to you, but like I said, we're starting at the very beginning. You're going to need cash. You're going to need a down payment to invest in real estate. Typically, at the time I'm making this video episode in the beginning of 2023, most lenders want to see a minimum of a 20% down payment. Lenders require a larger down payment on non-owner occupied properties because they're a greater risk to the lender. You're going to need 20% of your own money. Obviously, if you're buying something for yourself as a primary residence, you can put down less, as little as 3 to 5%, and then you just have to pay a private mortgage insurance on top of that, just as a reference point. I generally recommend putting down a little bit more money. This is just a bigger safety net for you. If you're investing in real estate, typically lenders are going to want to see you put more money down, not less money down. Ultimately, how much money you have saved up or will be saving up is really going to determine whether or not you invest in real estate. It will determine what you'll be buying. So obviously, if you're watching this right now and you have like $3,000 saved up, please don't expect to go out and buy a $200,000 property tomorrow. It's just not going to happen. But in the meantime, you're on the right track. Watch these tips and start saving up now. Learn these strategies and be able to implement them. Now, when you have saved the money, so we're assuming you're either in the process of saving for a down payment or you already have saved for the down payment. Number 1, unless you're buying the property outright in cash, which I have a feeling is probably a very few of you are going to be paying cash, you're probably going to need to get a loan on the property. In order to do so, you're going to have to work on your credit score. That means if your credit score is like 550 and you have like 2 credit cards and late payments on both of them, maybe a few accounts with collections, chances are you're going to have to take care of the score first before you even think about investing in real estate. Now, ideally, anytime you go and get a mortgage, you'll want to get a credit score above 670. That's a good score. You really want to get as high a score as possible. Ideally, you want to be above 740, which is considered excellent credit. The thing is, to get the best rate on your mortgage, you are going to want to have above a 740 credit score. Now, this is why, y'all, with a score over 740, you're going to get the best rate. The lenders give you the best rates possible the higher your score. Now, under that same threshold, you're actually seen as a riskier borrower. Because of that, the bank will charge you a higher interest rate. This just means less money in your pocket at the end of every month. So you want to have a good credit score to start out. You want to have a few active lines of credit that you've always paid on time, nothing late, nothing in collections, and goodness, no judgment. If this isn't you, take my advice and work on your credit first. You're really going to need to make sure everything old is paid off in full. You don't want to have any accounts in collections, none. You do not want to have any late payments. None. Check your report. Find something that isn't yours or fraudulent. You can dispute it and try to get those erroneous items removed. There are a whole bunch of videos on YouTube about how to clean up your credit score. It's not that hard. If you just don't have time or the gumption to do it yourself, there are many companies who can help you for a fee. Just Google it and choose the one with the best reviews. Number 2. Now, assuming that you have a decent credit score and have somewhat of a down payment and you're saving for it, you will need to have your tax returns in order. Now, anytime a lender looks at your tax returns and tries to give you a loan, especially if you're self-employed, they're going to look at the last 2 years of your tax returns, and they're going to take the average between those 2 years. This means that if in 2020 you made $50,000 and in 2021 you made $100,000, the average of that is $75,000. And that is the amount the lender will loan you based on your average income. In addition, lenders usually want to see anywhere between 2 months and 6 months of your bank statements. They are going to want to see proof of employment. They're going to want to see proof of income. They will want to see proof of any other liabilities or assets that you may have. Get these documents in order because they will be asking for it. Now, it's really important that if you're planning to invest in real estate, that you don't just deduct everything from your self-employed tax returns to avoid paying taxes. Folks have been pretty aggressive about deducting as many expenses as possible against their income. But y'all, when lenders go and look at your tax returns, they see the much lower amount that you're reporting that you make after all of your expenses. They're loaning you just based off of the net income. That means if you think you're all slick because you make $100,000 a year and you write off $80,000 as expenses to lower your tax bill, good luck getting a loan now, slick. Prior to getting a property, I recommend going a little bit lighter on your expenses so that way you end up having to pay more taxes, but on the flip side, you can qualify for a larger loan, which is more important because you're showing more income. It's very important that you make sure to take care of this and anticipate this in advance. Number 3, I talk to people every day and they tell me, oh, I don't need an approval until I have an offer accepted. No, I hate to break it to you. All sellers require proof of funds with an offer or a mortgage pre-approval letter. Y'all, on some properties, the sellers want to see proof of funds or a mortgage pre-approval to tour the property. In the real estate world, those people who just look for entertainment and dream about buying instead of putting in the work, well, we call them looky-loos. Please don't be a looky-loo, y'all. Talk to a lender before you do anything. Otherwise, I promise you, this is what's going to happen. I've seen it happen, y'all. You are going to go out, you're going to start looking at properties, and the first place you see is going to be absolutely perfect. You're going to love the location, the neighborhood, the lot, the layout, the finishes, the neighbors. You've taken selfies and put it on social media. Buying a house, homeowner. Then you go to the lender and find out that the place is way over your price range and you simply can't afford it. You are rapid fire looking for those posts, trying to delete them. Heartbroken, embarrassed, and deflated. I've seen it happen. You're going to be heartbroken. Comment below and tell me if you have ever experienced this very issue. I promise you, everything else you see, you're going to compare it to the place that you missed out on, the one that you couldn't afford. It's just not going to be a pleasant experience for anybody involved. Instead, here's what you're going to do. Call a lender first. Give them all your paperwork. I'm talking about your tax returns, your bank statements. You don't want a bunch of dings on your credit report. If you don't have any idea what your credit score is, I highly recommend you view your credit report on creditkarma.com. This is good information to have when you go to meet with the lender. The lenders will take your score from the credit bureaus and your documents, and they'll be able to punch in some numbers in their system, and they'll be able to roughly tell you what you'd be able to qualify for. This is so important, y'all. Do this for a few reasons. You know from the lender exactly what you can afford. This way you don't waste your time or anyone else's time. Trust me when I say you do not want to fall in love with a property that is out of your price range. This should be a pleasant experience. If you see a property you really do like, you are ahead of the game. You've saved a lot of time because you've already done the work. You've provided all the information to the lender. They've given you a pre-approval letter based on credit, assets, and income, and they're pretty much ready to go, just pending the property appraising for the contracted amount. I'm telling you, this with over 16 years of experience, it happens all the time. You find a property that's worth buying. Chances are people who want it just as much as you do are out there right now. So it's so important that you hit the ground running, have all your paperwork ready, and your pre-approval in your realtor's hand. When it comes to investing in real estate, timing is key. The quicker you can act on something, the better deal you're going to get. So you have your pre-approval out of the way. You've spoken with the lender and got together, and y'all figured out exactly what you could qualify for. Now, this is where I would start looking online. Check out all the properties on the market. Visit my website at www.gulfcoastdreamhomes.net. Y'all, this should really be the fun part. Look at everything you possibly can within your price range. You could even bump it up a little bit just so you're able to see properties that are a little bit more expensive to compare them to the ones that you're looking at. Once you've narrowed down your list to your favorites, tour those properties. The more properties you see, the better. When it comes to buying real estate, I try to tour everything on the market and my price range within reason online. Pick out my favorites. When I see the right one, I'll know it immediately. The more you look, the more you're going to know exactly why something is priced the way it is. You're going to see what upgrades are reasonable. You're going to see what upgrades are not reasonable. How well is something priced if it's in good condition? You're going to have a really good understanding. Now, once you've seen a lot of the homes on the market, you could end up seeing the perfect deal, but not recognize it because you have nothing else to compare it to. There are people who like to buy property out of state or out of town. Now, I buy local. I want to see how the area is changing firsthand. Because of that, I feel like I have an advantage over someone else who doesn't see those things day to day. If you buy out of town or out of state, it's going to be a lot harder to notice some of these subtle trends unless you have someone you really trust or can rely on, or a really good realtor. Even then, you take a risk relying on somebody else without fully understanding the deal yourself. Now, y'all listen up now. I'm not saying it can't be done because there are many successful real estate investors that invest out of state. I'm just saying it carries its own set of risks. You really need to understand what you're buying and investing in. Now, when it comes to me, I don't invest in properties on the real low end, and I don't invest in properties on the real high end. I like to be in that middle range, the bottom of that middle range, if that makes sense at all, just below the average price in the area. I can target the biggest buyer pool possible. Now, just because I'm in that lower middle median price point, it means there's usually a little bit more room for upside potential for me to fix it up and increase the price for rent. When it comes to renting it out, the property is just more affordable. If you think about it, if you're going to find a lot more tenants who want to live there, and also one more thing, and I'll call this number 4.5. What type of property should you look for? I don't generally look at condos. That's just me. I know many of my investors who love condos, and I love selling condos. Hear me out though. For me, there's not a lot of room for upside. You surely can't build out or up. You can't increase the square footage. Y'all remember, you are at the mercy of the Condo Owners Association. Not to mention, you need to factor in monthly fees, special assessments. You can eat into your profits pretty quickly. For that reason alone, I prefer single-family residences or duplexes or triplexes or even fourplexes, which means 2 to 4 units. The reason I like these properties is because you get to qualify for conventional financing. Conventional is a lot easier to get than commercial financing. If you ever decide to sell in the future, you're not only appealing to investors, but you can also appeal to owner-occupied users. Some of my buyers love a duplex or a fourplex using FHA financing. They live in one of the units and rent out the others. 5 units or more would be considered commercial. Number 5, You need to determine if the property cash flows. Is it going to cover your expenses? The reality of it is that 95 to 98% of the properties that you'll tour, well, they're not going to cash flow. I don't care how pretty it is. If it's not going to cash flow, it's not a good deal. On the flip side, everything's a good investment if you can buy it at the right price and hold on to it long term. So it's very important to understand what these numbers are. Now, what to look for now? If you're ever looking at a property or an area and you have no idea what it's going to rent for, just check out har.com or your local MLS or Facebook Marketplace. Look at the area, find out what other properties are renting for. You can compare the property to the one you're looking at. But anyway, going back to the cash flow. In order to understand cash flow, you're going to first need to understand exactly what the ownership costs of the property are. You need to consider how much money you're putting down. You need to consider what your mortgage is going to be. You need to consider what your interest rate is going to be and the loan terms. I hope you go with a 30-year fixed rate mortgage. Once you know these things, you can plug in these numbers. Just Google mortgage calculator. So let's look at the numbers. $400,000 property, assuming you put 20% down as an investment property, that's a $320,000 loan amount, a 7% interest rate. Now, your monthly payment would be $21.20 a month. Now, you need to also calculate what your property taxes are. If you're in Texas, it's about 2% of the appraised value, which on $400,000 is going to run you about $8,000 annually, divided by 12, about $670 a month. Next, you need to factor in insurance. This $400,000 property might have an insurance premium of $3,200 annually, so we'll use $267 a month in insurance. So tack that on your list of expenses. I recommend speaking with your insurance agent to find out the ballpark number before you buy. From there, you're going to have a lot of other random expenses you're going to need to account for. Lawn maintenance, pest control, appliance repair or replace. Or you're going to have plumbing issues, everybody does. Whatever it might be on the property that you will be paying for as the owner, you need to factor in. Pool maintenance, supplies. Is there an HOA? Is there an amenities fee? I usually try to use about a $200 a month buffer. You're going to have vacancies too every now and then. It's just a fact. Your tenants are going to move out. You're going to have some vacancies. You're going to have to fix it up. Maybe repaint it, replace the carpet. Please don't use carpet. Let's tack on another $150 a month on average. For that $400,000 property, it's going to cost you about $34.07 every single month. That also means in order to make the property cash flow, you're going to have to make more money than that to rent it out. Let's just say, for the sake of this example, that your $400,000 property is going to be renting out for $4,200 every single month. That means that you should see about $793 per month cash flow on an $80,000 down payment investment. Now, this works out to be about 11% cash on cash return. For anyone just starting, I never recommend buying a property that doesn't cash flow, or at the very least, worst case scenario, it has to break even. The last thing anybody wants is to be out of pocket to own an investment property. Not to mention the hassle that comes with the management. Don't get me started, y'all. That's actually a whole other episode. Make sure at the very least it breaks even. That should be your worst case scenario, that it breaks even. If it pays off your mortgage, good for you. The worst case scenario is it breaks even, right? Ideally, though, you need to make some cash flow on top of this. If you're just starting, the more cash flow, the better. Now, when it comes to finding a property that cash flows, it's often like finding a needle in a haystack. I've probably seen over 100 properties total in the 12 months, and only a handful of those properties will actually cash flow. So it's important to have patience and to really stick with the numbers and know what makes sense to buy and what doesn't make sense to buy. Remember, every property will cash flow at the right price. So don't be afraid to make reasonably low offers at a price point where it will cash flow. Now, I said reasonably low. Please don't lowball sellers. If the owner says no, well, that's fine. But every property will cash flow depending on what price you buy it at. Number 6, look for properties that need minor cosmetic renovations. This is where I see all the upside. Ideally, you want a home where all the unsexy hidden stuff is redone, like the roof, the foundation, the plumbing, the electrical, and the HVAC. This is huge. You want to know the condition of those main systems. All the things you don't see when you tour the home. After all, sometimes it's just cosmetics. Yeah, it looks like that 70s show. Everything's functional though. It's just not pretty. It's old, outdated kitchens, old, outdated bathrooms, old, outdated floors, old, loud or peeling paint. Maybe it just needs some landscaping. Things like this are really easy to fix in a relatively short amount of time, and they really don't take a ton of money. I've seen so many places where if you spent $30,000 fixing it up, you can increase your cash flow by $600 every single month. That is a tremendous return on your investment. When you're just starting out, chances are you're not going to know which upgrades are best or common or how much something is going to cost. But trust me, the more you end up seeing, the better you're going to get at it. Understanding what specific renovations will get you the best return on your investment. I like word of mouth referrals for contractors. It's not worth it to find some guy on Nextdoor who ends up walking up the job paid in full, and you have to pay twice as much to fix his screw ups. I recommend usually getting 3 bids. Now, not every contractor is going to be perfect, but I highly recommend that you make sure when you meet with these contractors, ask them as many questions as you can think of. I don't think any question is stupid, really. Ask them their opinions on things. Ask them, would they recommend doing something like this or like this? See if they know what they're talking about or if they hem-haw around. Again, the more opinions you get, the more knowledge you get. Even with good people, this is going to happen. I promise you it's going to happen. It happens to everyone. You just have to expect it to happen because 100% it's going to happen to you. Every single time it happens, every renovation you do, the renovation is going to cost you 20% more than you think it will, and it's going to take 20% longer than you think it will. You're just going to have to trust me on this. So go ahead and budget accordingly. They give you a bid of $20,000, expect it's going to be $24,000. And if they tell you it's going to be done in a month, it'll probably be done in a month and a half. Offer them a bonus if they finish on time or a deduction if they run behind on that completion date. Every single time, it always turns out this way without exception. Don't expect anything to be done exactly on time for exactly the price quoted. It's rare. It's also really important that if you're renovating this place to rent out to tenants, you make it as renter-proof as possible, which means don't do real hardwood floors, do laminate. Please don't put in really expensive countertops that can crack or break or stain. Put in very durable countertops or imitation-looking stone. Don't put down expensive granite. I promise you, you are going to regret it. Tile floors are pretty much indestructible. Depending on the area, you may want to just tile instead of laminate. I like a ceramic wood look plank. Tile is one of those things that you can't mess up. I also recommend that at all costs, do not use carpet because it will get filthy. You are going to have to replace it after every single tenant, and that really adds up over the long run. Also, don't do anything too expensive. You have to trust me. They're going to break everything. I have no idea how they do it, but if you put nice things in there, they're going to break it. The last little thing I want to mention is that I want to avoid certain properties in certain locations. The first one to keep in mind is that you cannot change the location no matter what you do. I don't like buying anything that's like right next to an airport or a school or anything on a busy street. I don't like buying anything if there are 2 street lights on either end, because that means cars are going to pass through all the time. If there's ever any traffic in just sort of any business district, it's usually not good. I also like to make sure the property I get is not backed up to a huge apartment building or a commercial building, right behind a big parking lot or a mall, right? All of those things bring down the value. This just means that in the future, it's going to be much harder to sell. There's going to be less resale value there's going to be less upside than if it didn't have those things. Number 7. Now, assuming you've found the perfect place and you've talked to your lender and you got your credit or your tax returns and all of that's really good, you can start making offers on properties. Now, just expect that on every offer you make, it's not always going to work out. Listen, I'm going to be honest with you. I lose out on some offers because I do offer a little than listing. I offer at a price where it makes sense for me to buy it because the numbers work. And if it goes any higher, that doesn't make sense for me to buy it, and I won't buy it. If it doesn't cash flow, I'm not going to buy it. You can't get emotional about it. You can't take anything personally. I literally look at the numbers and certain prices and expenses, and if it makes sense to buy, I buy it. If you're doing this, please work with a competent realtor. They'll know all the ins and outs of the contract, and they'll know the best strategies to negotiate depending on the specifics of the deal. They'll be able to help you out tremendously if they're a good agent. Likewise, working with a bad real estate agent will make your life a living hell. They will lose your deals. They will be impossible to reach. They won't have their voicemail set up. They don't respond to text messages. They don't respond to emails. They will not know what they're doing. It's going to cost you a lot of money if you end up working with an inexperienced or part-time agent. So in order to find an experienced full-time real estate agent, definitely interview them. Word of mouth is my favorite ways to meet different agents. That's how I end up with a lot of my clients, but I also find out how quickly they respond back to you. If you send them a text, did they respond immediately? Or did they get back to you the next day? If you try calling them, does it take you hours to be able to reach them? Days? Do they even respond at all? Or do they pick up on the second ring? I don't understand why a realtor won't get back to people. That's how we make a living. I wonder how do these people stay in business? It really doesn't make sense to me. But more importantly, when it comes time to make an offer, don't get caught up in the excitement of writing the offer. I'm not competing against all these people. I'm trying to win. You end up overpaying for the property. Don't be stubborn enough to miss out on the perfect deal just because you don't want to come off a few $1,000s. It might be the perfect place. It's worth it to pay a fair price for the right deal than to try to get a steal of a deal for the wrong property. I'll definitely pay more for quality, peace of mind, and ease of transaction. I'll usually pay a little bit more for a nicer area than going into a lower end area to save some money and dealing with riskier, problem-prone tenants. Number 8, you've had a lot of frustration getting started. You want to pull your hair out. Maybe you have a few decent condition properties. Be sure to inspect as many things as you possibly can. I'm talking about the roof, the electrical, the plumbing, the foundation. Is there any mold? Is it acceptable? Heck, you can do radon gas inspections for all I care. I mean, I don't care what you do. Just do as many inspections as you can possibly think of. Then from those inspections, find out how much it's going to cost to fix these issues. Now keep in mind every single property, even the ones in amazing condition, are going to have some issues. It could be a brand new, perfect new construction home. An inspector will no doubt uncover something. Now, it's important that when you find these issues, tally up how much it's going to cost and then ask the seller for a credit or a price reduction to compensate you for these issues. Always ask, even if they say no, we're not giving a single dollar, it's as is. You know, they always say that, by the way. Always ask for a credit. Just ask for something. Literally, you have no risk by asking. The worst thing they can do is tell you no, and that's fine. You can decide then, but always ask. Most of the time, the sellers will give you something. I usually see inspections as a second round of negotiation because even though you were able to get your offer accepted, now you did your inspections, and this is your chance to bring down the price a little bit more. So now you're in the escrow process, and you're going to have to understand exactly what the costs are now. Number 9, you're going to have escrow costs. You're going to have costs, lender fees, different miscellaneous fees. A lot of things like this, usually on average, it totals about 1% of whatever the purchase price is of the property. This means on a $400,000 property, chances are there's going to be about $4,000 for those fees that's in addition to your purchase price. Number 10, this is also some of the fun part, the renovation. Now, if you bought the property that doesn't need any renovations, just skip this part. When I start a project, I start as soon as possible. I'm talking about the day I close if I can. This avoids having any downtime on the property. I want to get it rented out sooner rather than later. But like I mentioned earlier, most of my contractors I find through word of mouth or on Yelp, and they've been fantastic. Now, there is one thing when it comes to renovating your property is that you always need to be on site. I recommend to be on site every single day. Hear me out. I don't care if it's a minor renovation, if you're doing a bathroom and a kitchen, doing the whole place. I don't care if you're spending $5,000 or $50 million. It doesn't matter to me. You're going to be at that property every single day to supervise, because I promise you, things are not going to go as planned. I promise you, things will come up, and I promise you, they will do something wrong. And if you weren't there, you wouldn't even notice these things. One of the advantages, too, of being on the site every single day. Y'all, you have got to go at least in the morning. Show up random times. This way, you get to make sure the project is going to stay on time. A lot of times, I've shown up to projects at like 2 in the afternoon on Friday, and nobody's there. Or one person's there, and there should be 5 people working on my floors. You have to call that contractor. Where is everybody? Why aren't they here? They move them around job sites. Sometimes a contractor will overbook and then move them to whoever complains the most and whoever's job is the most important. They generally move those people there. So unless you're there every single day and you have to tell them, you gotta finish, you gotta finish, you gotta finish, you have got to finish, you've got to stay on track. Y'all, the squeakiest wheel gets the most grease. And if it's not, it's just gonna drag on and on. Number 11, assuming all the renovations are done, you are ready to rent out the property, and this should also be the fun part of finishing up the whole process. Now, the number one thing you need to do when renting a property is take really good pictures. 98% of people look online for a place to live. So many landlords sit around with their iPhones. They just start taking pictures of a bathroom. They're blurry. They don't capture the entire room, or the toilet lid's up. Does it have a sink or a shower? Does it have a floor? Show it. If you want top dollar for your rental, I highly recommend you pay for professional pictures. They are going to make your property look amazing. I don't care if you're renting it out for $600 a month or $10,000 a month. Get professional pictures. Also, make sure that if anyone contacts you to show it, that you respond back to them immediately. Because when these renters are looking, they are in the moment right now. They want to see it right then and there. Y'all, they're all excited about your property. And if it ends up taking you a few days to get back to these people, well, they usually just go find something else. You don't want to miss out on this, especially when you're trying to rent it out for top dollar. It's just so easy. It is just so easy to pick up the phone and get back to people and be able to show it as soon as they want to see it. Now, as far as advertising it online, I personally like to list it myself as an agent on the MLS that syndicates out to everything else. I put it on as many social media sites as possible because you really have no idea. Share it with your friends, your neighbors. They may know somebody looking for a rental just like yours. Now, this is important. You want to screen your tenants. Google and know who your prospective tenants are. Have them provide a credit report. Number 12. This is where it gets really good, y'all. Now, you get to start scaling up over time. I highly recommend you keep the rental property you bought for about a year or 18 months so you get accustomed to it. Get some good renters in there. Understand what you're doing and then start saving up for another down payment to go and do this again. At this point, it's pretty much just rinse and repeat. The more deals you do, the better you're going to get at it. The better you're going to get at picking renovations. The better you're going to get at finding the good deals. So your first one is going to be a learning experience. From there, you're just going to get better and better and better. Now, this is definitely not going to turn into a multi-million-dollar empire overnight, y'all. That's unrealistic. I think it's absolutely achievable over the next decade to maybe 15 years or so for you to imagine if you end up buying a duplex every other year. That's all you got to do is buy a duplex every other year, rent it out, make sure it's cash flow positive. 2 years later, go buy again. Within 10 years, you're going to have 10 units or 5 duplexes. They're all going to be cash flowing, all paying for themselves. And after 30 years, all of them are going to be paid off. Having 5 properties all paid off after 30 years, that's one hell of a good retirement. That is just a 10-year strategy that you could implement. Start getting this process done now, and that way, over the next 10 years, you'll build everything up. Let it run for 20 years. Haven't been paid off, and you're going to sit back on so much cash, you're not going to know what to do with it. If you've enjoyed this video episode, you're really going to love the next one.